Now, a very good afternoon, investors. You're on KleverStock with me, One Izzle, and I will be serving you the midday roundup with the latest market updates from this morning up until now. Kicking it off with Bursa Malaysia updates. The FBM KLCI, they maintained its footing above the psychological 1,700 point threshold on Wednesday morning, despite a minor pullback as investors locked in profits following Tuesday's 7-year high. The benchmark index slipped 2.32 points to 1,705.88 at around 9 a.m. this morning, as the local bourse tracked a weaker performance on Wall Street. Now, global sentiment was dampened by a decline in JP Morgan Chase's share price, which fell 4.2% despite beating earnings expectations, as traders reacted to U.S. President Donald Trump's proposed cap on credit card interest rates. TA Securities noted that while the return of foreign funds to blue chips is a positive sign, the recent price surge has led to mildly overbought technical conditions. This suggests that rising profit-taking interest may limit immediate gains. Now, the research firm identified the next resistance level at the October 2015 high of 1,727, followed by a hurdle at 1,759. On the downside, immediate support is seen at the September 2016 low of 1,645, with a stronger floor established at the 1,610 mark. Rakuten Trade remains optimistic that the current blue chip accumulation will eventually encourage broader participation in the market. The firm stated in a research note that we believe stock accumulation of blue chips to continue for the time being. Thereafter, we may experience heightening participation in the smaller cap space. Now, this sentiment comes as the FBM KLCI's rise past 1,700 was underpinned by a steady emergence of foreign buying, providing a spillover potential for small cap stocks that have recently been sidelined. In the banking sector, Malaysian lenders showed resilience even as their US counterparts faced selling pressure. Maybank, which hit a record close in the previous session, edged down only 2 cents to 11 ringgit 4 cents, while Public Bank and Hong Leong Bank posted modest gains of 1 cent and 4 cents respectively. Meanwhile, Capital A saw active interest, jumping 3.5 cents to 47.5 cents, ahead of the scheduled distribution of AirAsia X shares to its shareholders this Friday. We now move on to some local currency and foreign exchange. The Malaysian ringgit opened on a softer note against the US dollar this Wednesday, pressured by a strengthening greenback as investors sought safety amid escalating geopolitical risks in Iran and domestic political friction in the United States. At 8 a.m. this morning, the local unit slipped to 4.0600 or 4.0680 against the greenback, down from Tuesday's close of 4.0555 or 4.0600. Now, Bank Muamalat Malaysia Berhad Chief Economist Dr. Muhammad Afzanizam Abdul Rashid, he noted that the US dollar index climbed 0.29% to 99.152 points. He attributed this rise to heightened geopolitical risks following extensive protests in Iran, which have drawn sharp warnings from the Trump administration. Now, Afzanizam said that this suggests potential interference from the US is increasingly likely. He also noted that such uncertainty often drives capital toward the dollar. Now, domestically, in the US, newly released macroeconomic data shows that inflation remains sticky. Headline inflation was sustained at 2.7% in December 2025, while the core inflation rate, excluding volatile food and energy, moderated only slightly to 2.6%. Because these figures remain significantly above the Federal Reserve's 2.0% target, the central bank is expected to maintain its benchmark interest rate at the upcoming meeting. Muhammad Afzanizam said that this might fuel further tension between the Fed and the Trump administration, referring to the ongoing attacks by President Trump on Fed Chair Jerome Powell. The administration has recently escalated its pressure with reports of a Department of Justice investigation into the Fed chair, a move that has unsettled global markets and raised concerns over the independence of American monetary policy. Now, despite the decline against the dollar, the ringgit demonstrated resilience against other major currencies at the opening. Our ringgit appreciated against the Japanese yen to 2.5499 or 2.5551. It also strengthened against the euro to 4.7267 or 4.7360. Our ringgit also gained ground against the British pound, trading at 5.4506 or 5.4613. Performance against ASEAN peers was mixed. The ringgit did edge up against the Singapore dollar at 3.1495 or 3.1562. We also got up against the Thai baht at 12.8697 or 12.9008. But our due diligence did record a slight loss against the Indonesian rupiah and the Philippine peso. Market participants remain watchful of further developments in the Middle East and upcoming U.S. economic indicators that could sway the Federal Reserve's stance later this month. Now, for some local economic news. Perodua has reported a record-breaking performance for 2025, with sales volume rising to 359,904 units, a 0.5% increase from the previous year. Now, this achievement was complemented by a 0.6% growth in production, reaching 370,370 units. Proda President and CEO Datuk Seri Zainal Abidin Ahmad stated that the company's internal estimates place its market share at a dominant 43.9%. He attributed the success to a resilient demand for value-driven vehicles, noting that we have successfully broken our previous records set in 2024. The Perodua Beza remained the nation's top-selling model for the second consecutive year, with 100,488 units registered in 2025. This was followed by the Axia at 84,291 units, and then the Myvi at 72,724 units. Collectively, these three models solidified Perodua's foothold as the leading choice for Malaysian car buyers. The company also anticipates the country's total industry volume, or TIV, for 2025 to reach 820,000 units, signaling a healthy appetite for new vehicles despite intensifying competition. While 2025 marked a historic high, analysts from Maybank Investment Bank Research expect domestic vehicle sales to remain flat in 2026. The brokerage has maintained a neutral stance on the automotive sector, projecting a TIV of 790,000 units for 2026. Analysts also pointed out to structural shifts as a primary factor, with the market transitioning from a demand-led recovery toward a phase defined by electrification and localization. The research firm noted in an update that medium-term earnings visibility remains clouded by external risks, particularly geopolitical tensions and currency volatility. Now, the sector also faces potential headwinds from policy changes, including the revised open market value excise duty framework, which has been postponed to mid-2026. Additionally, the expiry of tax incentives for fully imported electric vehicles, or EVs, at the end of 2025 is expected to pressure margins for certain manufacturers. However, Perodua is positioning itself for this shift, having launched its first battery electric vehicle, the QVE, alongside the Traz model in late 2025. The sales impact of these new models is expected to materialize more significantly throughout 2026. Sime Darby Berhad and Tan Chong Motor Holdings Berhad are also adapting to these market changes. with the latter involved in Produa's maiden EV project and the CKD assembly of the Wuling Bingo EV. Despite a challenging outlook for 2026, the Malaysian automotive ecosystem continues to benefit from local manufacturing. Produa alone purchased 11 billion ringgit in parts from local vendors last year. Zainal Abidin reaffirmed the company's commitment to its role as a nation builder, stating that Produa will continue to invest in people and technology to ensure the domestic supply chain remains competitive. Continuing with more economic news updates, headline activity in Malaysia's property market is no longer a sufficient indicator of underlying dynamics, as success in the sector is now increasingly dictated by infrastructure readiness, capital discipline, and alignment with long-term demand. Now, according to Knight Frank Malaysia's latest report for the second half of 2025, the real estate market has reached a clear inflection point where performance has become fragmented, requiring a strategic realignment for developers and investors as they head into 2026. Knight Frank Malaysia Group Managing Director Keith Oy noted that the market is no longer moving in a single direction, with a distinct separation emerging between assets that align with structural demand and those that do not. Oy said in a statement that over the past 6 months, we've seen a clear separation between assets that are aligned with structural demand and those that are not. In this environment, performance is determined by alignment, discipline, and execution rather than momentum alone. Now, the industrial and logistics sector remains a resilient pillar of the market, though its performance is being reshaped by operational efficiency and infrastructure readiness. The report highlighted that US tariff measures in 2025 initially disrupted regional trade flows, creating temporary dampening effect on export-oriented manufacturing. While domestic consumption provided a partial buffer, the heightened uncertainty led to a moderate impact on overall industrial activity, reinforcing the need for developers to focus on policy-directed environments and scalable infrastructure-ready sites. A significant shift was also recorded in the data center sector, which has moved from a phase of high-profile investment announcements into a phase of critical execution. Knight Frank pointed out that growth is now tied to delivery certainty, governance readiness, and access to essential resources like power. The firm stated that the sector's growth is increasingly tied to delivery certainty, governance readiness, and access to critical resources. They also warned that projects facing infrastructure or approval constraints are already experiencing delays. Future investments in this space are expected to be defined by sustainability and economic multiplier impacts rather than just scale. In the retail and hospitality sectors, the outlook remains cautiously optimistic. Retail performance held firmer than expected in the second half of 2025, supported by daily needs retail and experience-led formats. Yui Mei Chi, Knight Frank's retail management and consultancy lead, noted that landlords are now prioritizing tenant retention and mix optimization over headline rental growth. As competition intensifies in overlapping catchments, meanwhile, the hospitality sector is positioning itself for Visit Malaysia 2026, with operators already adjusting room inventory and pricing strategies to meet the anticipated surge in cross-border travel and event-driven tourism. In contrast, the residential market saw a modest cooling in late 2025, reflecting buyer caution regarding affordability and a persistent supply-demand imbalance. While demand remains active, Knight Frank observed that buyers are becoming more discerning, leading to a self-correction in certain markets through pricing and product discipline. Now, the firm concludes that the central challenge for 2026 is not a lack of demand, but rather ensuring that property strategies are strictly aligned with the infrastructure and execution fundamentals that now define value. We'll take a short break, but don't go away. After this, we will return shortly with corporate news developments. See you soon. And welcome back to the Midday Roundup. Let's continue with some corporate news updates. HE Group Berhad has kicked off the 2026 financial year by securing its first contract, a power distribution system project valued at 12.6 million ringgit for manufacturer of electronic products. Now, the contract, accepted through its wholly owned subsidiary Hexatech Engineering Sdn Berhad, is expected to yield approximately 1 million ringgit in profit after tax and minority interest over the duration of the project. Now, work on the assignment commenced on January 12th and is slated for completion by November 30th, 2026. Research houses have reacted positively to the news, noting that while the contract size is relatively modest, it significantly strengthens the group's earnings visibility for the current year. Phillip Capital Research observed that this win accounts for 5.5% of its full-year replenishment target of 230 million ringgit, bringing HE Group's current outstanding order book to approximately 100 million ringgit. The research firm reiterated its buy rating with a target price of 51 cents, citing an undemanding valuation and the group's strong track record in the semiconductor and data center sectors. Maybank Investment Bank Research also maintained its buy call with a target price of 48 cents, underpinned by the group's substantial tender book of roughly 850 million ringgit as of late 2025. Now, analysts expect more job flows to materialize from the semiconductor, medical device and data center industries, particularly as Malaysia continues to attract high-value investments in advanced manufacturing. Maybank IB also noted that in its report that the latest win indicates improving job flow and from the semiconductor and electronic sector amid sustained investments in Malaysia's electrical and electronics ecosystem. In the market today, HE Group's shares remained steady, trading at 38 cents at mid-morning. Investors appear to be weighing the group's growth potential against risks such as potential project delays or margin pressure from rising costs. However, management's previous successful penetration into the renewable energy sector and its recent transfer to the main market of Bursa Malaysia are seen as key factors that could attract a broader base of institutional investors. As the company works through its 850 million ringgit tender pipeline, of which over 80% is linked to data centers, analysts believe the group is well positioned to exceed its annual order book targets. Up next, we have some business updates. Velocity Capital partner Berhad, also known just as Velocity, has completed its full exit from MMAG Holdings Berhad, disposing of its entire 6.46% equity interest through a series of open market transactions. The disposal, which involved a total of 150 million shares, was carried out for a total cash consideration of 9.43 million ringgit. According to a filing with Bursa Malaysia, the divestment was executed in two tranches: a sale of 32.6 million shares on January 9th for 2.12 million, followed by the remaining 117.4 million shares on January 12th for 7.31 million ringgit. The shares were offloaded at prices ranging between 6.224 cents and 6.5 cents per share, reflecting the prevailing market conditions. Velocity, a group with core interests in transportation, logistics and ceramics, had originally invested 60 million ringgit to acquire the stake in March 2025 at an entry price of approximately 40 cents per share. The group noted that the disposal resulted in an estimated loss of 324,024 ringgit when measured against the investment's most recent carrying value of 9.75 million ringgit, following significant fair value adjustments previously recognized. Velocity's board explained that the primary rationale for the exit was to manage investment exposure and preserve financial flexibility. While the initial investment was intended to foster a middle-mile logistics collaboration between Velocity's Line Haul City and Berhad and MMAG's Line Clear Express City and Berhad, adverse market conditions and continued volatility in MMAG's share price led to a significant decline in the investment's value. The board emphasized that maintaining the stake would have exposed the group to further downside risk, making the disposal a prudent decision to limit further potential losses. Despite the equity exit, Velocity clarified that it remains committed to its operational partnership with MMAG, which continues to provide synergies for its logistics businesses. Now, the proceeds from the 9.43 million ringgit sale are earmarked for working capital, future business expansions, and potential acquisitions. This move follows a period of high volatility for MMAG shares, which have seen a sharp decline from their 2025 highs, prompting various institutional and substantial shareholders to re-evaluate their positions in the courier and air freight specialist. Finally, we're going to be wrapping it up with some major corporate developments and deals across Malaysia. Here are the headlines. At number 1, Capital A Berhad said the distribution of AirAsia X Berhad shares to its shareholders is expected to take place this Friday, January 16th, paving the way for the company to submit its application for PN17 upliftment. Our next headline, LBS Bina Group Berhad is optimistic about the 2026 property market and expects it to remain positive and resilient, supported by strong demand. At number 3, the headline reads, Rimbunan Sawit Berhad is disposing of a 1,504 hectare parcel of plantation land in Miri for approximately 28 million ringgit cash, as it moves to exit the remote estate that has been weighing on its operating efficiency and profitability. At number 4, Selangor Dredging Berhad is acquiring a freehold parcel of commercial land in Petaling Jaya for 63 million ringgit to expand its land bank, with the site earmarked for proposed development carrying an estimated GDV of 507 million ringgit. At number 5, the headline is VStex Berhad, via its wholly owned subsidiary VStex Asta Sdn Berhad, has been appointed by Agibot Innovation Shanghai Technology as a distributor of Agibot's humanoid robotic solutions in Malaysia. And finally, Velocity Capital Partner Berhad has sold off its entire 6.5% stake in MMAG Holdings Berhad for 9.4 million ringgit, citing exposure to further downside risks. And that is a wrap for the Midday Roundup with me, Wanizul, on KleverStock. Thank you for choosing us, investors. Stay tuned for our upcoming live stream, and we'll see you shortly after this. Have a good day ahead.